In 1989, the land under Tokyo's Imperial Palace was said to be worth more than the entire state of California. Not the buildings, just the dirt under one quiet park in the middle of Tokyo, supposedly more valuable than Hollywood, Silicon Valley, and every beachfront mansion on the Pacific coast combined. Japan had become, on paper, the richest country in human history. A few years later, it was trapped in deflation, ghost towns, and decades of near-zero growth. We're going to follow the money through that rise and fall. You'll see who actually held the wealth, what invisible debt was building under the party, and the black swan moment when trust snapped, from city pop nights and gold leaf sushi to zombie companies, abandoned theme parks, and the yen carry trade that still haunts global markets. Picture Japan in the early 1980s. For 3 decades after World War II, the country had pulled off an economic miracle. Shipyards, steel mills, car factories, and electronics plants worked with almost religious discipline. Japan Inc., the alliance between bureaucrats, banks, and manufacturers, seemed unstoppable. Real incomes more than doubled in a couple of decades. Tokyo was rising into a forest of glass and concrete. By the mid-80s, Japanese companies dominated televisions, cameras, cars, and memory chips. Japan was the world's biggest creditor. The United States, watching its own factories rust, pushed for change. On September 22, 1985, finance ministers from the US, Japan, West Germany, France, and the UK met at the Plaza Hotel in New York. Their Plaza Accord was meant to weaken the overstrong US dollar. Markets went further than anyone expected. The yen surged from about 240 to the dollar in 1985 to around 120 by 1988, a doubling in 3 years. For exporters, that was brutal. A Toyota priced at 2.4 million yen cost $10,000 at 240 yen to the dollar. At 120, the same car looked like 20,000 unless they slashed margins. The Indaka, high yen, felt like a mortal threat. The people who controlled the money panicked. The Bank of Japan slashed its key interest rate from 5% to 2.5%, a post-war low, and kept it there for years even as growth recovered. Cheap money flooded the system. Behind the scenes, the central bank reached for an old, powerful tool: window guidance. In the post-war years, this had quietly steered credit into steel mills and shipyards. Now it became something else. Imagine a smoke-filled conference room in Tokyo. A central banker tells a table of bank executives, "You lent 10 billion yen last quarter. Next quarter, it must be 15. Miss that, and don't expect our support." That was window guidance in the late 1980s. Informal but binding quotas to expand loans. But exporters, squeezed by the strong yen, weren't lining up for new factory financing. So the banks went hunting for anyone who would borrow. They found real estate developers, speculators, golf course projects, and holding companies. In a bank-centric system, land was the favorite collateral. Regulators and bankers both believed a simple myth: Japanese land, especially in cities, never falls in price. Loans were written against land values that were already rising just because credit was expanding. A self-feeding spiral began. Rising land prices boosted collateral. Bigger collateral justified bigger loans. Bigger loans pushed prices higher again. Who had the money at this stage? On paper, everyone. Developers could walk into a bank, gesture at a parcel of land, and walk out with vast sums at low rates. Corporations discovered a new game: Zaitech. Zaitech, short for financial engineering, was the practice of corporations turning themselves into part-time hedge funds. A big manufacturer could issue bonds at rock-bottom interest, then quietly pour that money into stocks and property. As the Nikkei and land prices soared, paper gains were booked as ordinary profit. To an outside investor, it looked like the core business was booming. In reality, many firms were riding the bubble. By the late 1980s, up to half the earnings at some major companies came not from selling cars or steel, but from financial bets. Their balance sheets were leveraged twice over, by debt and by dependence on ever-rising asset prices. Households were pulled into the vortex. In Tokyo, the cost of a typical home shot into the stratosphere. Multi-generational mortgages, 50, even 100-year loans that extended from parents to children, appeared just to make prices seem affordable. Private debt, households plus non-financial firms, climbed from roughly 140% of GDP in 1985 to over 180% by 1990. The invisible debt was psychological too, a whole society starting to believe that rising asset prices were a law of nature. Meanwhile, the streets of Tokyo turned surreal. In Ginza, a square meter of prime commercial land sold for over 30 million yen, about $215,000 at the time, or roughly $20,000 a square foot. By some estimates, all the land in Japan was worth 4 times all the land in the United States, even though Japan is about the size of California. At the height of the mania, analysts calculated that if you valued the 1.15 square kilometers under the Imperial Palace at nearby Ginza rates, that patch of green was worth more than all the real estate in California. Corporate entertaining, sitai, became ritualized excess. One junior employee was handed a budget of $10,000 per person per day to entertain visiting directors in Sydney. The goal wasn't thrift, it was to demonstrate how much the company could burn. Golf club memberships turned into tradable chips. A top course near Tokyo could cost the equivalent of several $1,000,000, bought as much for its speculative upside as for weekends on the green. And late nights were soundtracked by city pop, smooth bass lines, sax solos, neon-soaked album covers. It was music for people who believed the good times would last forever. December 29th, 1989. On the last trading day of the decade, the Nikkei 225 closed at 38,915 after more than tripling in a few years. At that moment, the Tokyo Stock Exchange accounted for about 42% of global stock market value. Japanese corporations were on a global shopping spree. Sony bought Columbia Pictures. Mitsubishi Estate took control of New York's Rockefeller Center. Outside Japan, commentators asked if Americans would one day work for Japanese bosses. Inside, that anxiety translated into pride and complacency. Many people spoke casually of the Nikkei going to 60,000 or 80,000. The sun had risen, it would not set. But there was one man who wasn't buying it, Yasushi Mieno, the new governor of the Bank of Japan. Where others saw triumph, he saw a dangerous distortion, an economy living off paper wealth, not productivity. He worried that speculation was being rewarded more than hard work, that prices were dry tinder waiting for an inflationary spark, and believed the only way to restore sanity was to prick the bubble. So he raised rates. In 1989, the BOJ pushed its key rate from 2.5% to 3.25%, then to 3.75%, then 4.25%. By August 1990, it stood at 6%. Borrowing costs had more than doubled in just over a year. At the same time, the Ministry of Finance imposed strict limits on bank lending to real estate. The credit hose that had been inflating land values was suddenly kinked. The bubble didn't explode in one dramatic day. It started to leak. The first sign was the stock market. Within months of the peak, the Nikkei had been cut nearly in half, dropping below 20,000 by late 1990. By 1992, it hovered around 14,000, down about 60% from its high. Trillions of dollars of paper wealth evaporated. Real estate lagged but fell harder. At first, sellers insisted prices would bounce back. Trading froze. Then forced sellers appeared. As properties finally changed hands at lower prices, the myth cracked. Over the 1990s, commercial land in major Japanese cities fell by as much as 80 to 90% from peak. Residential land in Greater Tokyo dropped by more than 60%. Nationwide, land prices slid for over a decade. Now zoom into a single balance sheet. In 1989, a company owns land worth 10 billion yen and owes 8 billion to the bank. On paper, it has 2 billion of equity. After the crash, that land is really worth 4 billion. The debt, still 8 billion. Overnight, the same company is technically insolvent, negative $4 billion in equity. Multiply that by thousands of firms. Banks looked worse. Those safe loans backed by ever-rising land had turned toxic. Over the next decade, Japanese banks would dispose of roughly 90 trillion yen in bad loans, and even that understated the damage. Yet when the recession hit, the usual tools failed. In a typical downturn, central banks cut rates, companies start borrowing again, and after some pain, growth returns. In Japan, the Bank of Japan drove rates towards zero through the 1990s. Money was essentially free. But something had changed in corporate psychology. Economist Richard Koo calls it a balance sheet recession. When your assets have collapsed but your debts remain, you stop chasing profit growth and start chasing survival. Your priority becomes paying down debt, not taking new risks. Even at zero interest rates, Japanese companies refuse to borrow. Households scarred by falling property and stock prices saved obsessively. Everyone tried to repair their balance sheets at once. In an economy, though, one person's spending is another's income. When every sector tries to save simultaneously, demand vanishes. Prices drift down. Deflation takes hold. That was the deeper invisible debt coming due. An entire society's overextension to rising asset prices, followed by a simultaneous retreat. The government stepped in as spender of last resort. Throughout the 1990s and 2000s, it launched wave after wave of fiscal stimulus. Trillions of yen went into public works. Roads, tunnels, dams, and bridges. Some projects, like the Akashi Bridge, the world's longest suspension bridge, were engineering marvels. Others became symbols of waste. Towering structures in sleepy ports with barely any traffic, the classic bridges to nowhere. Public debt exploded. Around 1990, Japanese government debt sat at roughly half of GDP. Today it stands above 200%, the highest among advanced economies. Private debt shrank as companies and households paid down loans. Public debt took its place. Meanwhile, regulators let banks hide the full scale of their losses. Rather than force mass bankruptcies, they allowed evergreening, rolling over loans to insolvent firms, lending just enough to cover interest on old debts. Those firms became zombies, too weak to grow, too protected to die. They tied up capital and labor, blocking healthier newcomers from entering. Growth averaged about 1% a year. Productivity stagnated. Japan slipped into what became known as the lost decades. The culture shifted just as dramatically. In the 1980s, gold leaf sushi and champagne in Ginza had been symbols of success. By the late 1990s, the emblem was the 100 yen shop. Chains like Daiso exploded, selling everything from tableware to tools for a single coin. Fast food chains waged beef bowl wars, cutting the price of gyudon to under 300 yen. The one-coin lunch, a full meal for 500 yen, became a point of pride. Consumers hunted for bargains, not brand names. Young people watched their parents lose jobs, homes, and confidence. Many decided they didn't want that life. This Satori generation, named after a kind of resigned enlightenment, often chose small apartments, few possessions, and lower pressure work over the old corporate warrior ideal. If the 1980s had been about more, the 2000s were about enough. The physical landscape carried the scars. Nara Dreamland, a knockoff Disneyland built in the 1960s and embellished during the boom, closed in 2006. For years, its rusting roller coasters and peeling castles stood in silence, an eerie monument to vanished optimism. Other bubble-era projects, like Gulliver's Kingdom and the Sigaya Ocean Dome, met similar fates. Giant leisure fantasies turned into hulks and weed-choked ruins. Across the country, millions of homes sit empty. These Akiya, abandoned houses, dot both countryside and suburb. In some regions, 1 in 5 houses is vacant. Projections suggest that by the 2030s, up to a third of Japanese homes could be empty. Drive through rural Japan today, and you can still see the bones of the bubble. Grand hotels with shattered windows, ivy-clad resort entrances, immaculate bridges stretching over quiet valleys. Yet Japan's story didn't end behind its own borders. The attempt to fight deflation created a new machine, the yen carry trade. By the late 1990s, after years of stagnation and falling prices, the Bank of Japan pushed interest rates effectively to zero. Domestic borrowers were still wary, but global investors saw an opportunity. The carry trade is simple in theory. You borrow in a currency with very low interest rates, convert that money into a currency with higher rates, invest in higher-yielding assets, and pocket the difference. In practice, that meant borrow yen at near 0%, convert to dollars or euros, buy bonds yielding 4 or 5%, or stocks in faster-growing markets and keep the spread as profit, so long as the yen didn't suddenly surge. Japan's deflation and ultra-low rates turned the yen into a global funding currency. Hedge funds, banks, and even Japanese retail investors, nicknamed Mrs. Watanabe, the archetypal housewife managing family savings, sold yen to buy higher-yielding foreign assets. When the yen strengthened sharply, those trades unwound in panic. Investors had to sell what they owned overseas to buy back yen and repay loans, sometimes triggering market turmoil far from Tokyo. In that sense, the long shadow of Japan's 1980s bubble extended into the plumbing of global finance. The same collapse that froze domestic borrowing made the yen the world's ATM. So looking back, how do our three questions shake out? Who had the money? During the boom, wealth concentrated in banks, developers, corporations, and urban landowners. Their assets swelled as stock and property prices rose. But much of that wealth was conditional, anchored to inflated valuations. The true winners were those who quietly sold into the frenzy and reduced leverage before the fall. Most clung on and watched it evaporate. What was the invisible debt? It wasn't just the obvious loans on bank balance sheets. It was a national dependence on ever-rising asset prices. Companies built strategies on Zaitech profits. Households took on multi-generational mortgages. Politicians implicitly promised that the state would shield banks and big firms from failure. When the bubble burst, that promise turned into colossal public debt, slow growth, and a generational trust gap. What was the black swan that broke the trust? Paradoxically, it was a deliberate act, the moment the central bank turned from fueling the boom to fighting it. Mieno's rate hikes and tighter credit weren't random shocks. But to a system built on the assumption of endless easing, they were an unthinkable reversal. When cheap money was withdrawn, it exposed how many balance sheets were hollow and how much of Japan's miracle rested on sand. The Japanese asset bubble can feel unreal. City pop nights, Imperial Palace land outpricing California. But it's not just a curiosity. Japan was the first rich country to experience what happens when demographics age, finance dominates industry, and central banks use extreme tools for too long. Today, many other nations carry huge public debts, rely on low rates, and nurture their own asset booms. If Japan's sun in the 1980s burned too bright, its long twilight since is a warning. Bubbles aren't only about greed, they're about stories we tell ourselves, about what can never fall and what must always rise. For Japan, that story was land and Japan Incor's supremacy. For us, it might be tech stocks, housing, or something we haven't named yet. The lesson from that quiet patch of trees in central Tokyo is stark. When the price of something stops making sense, but everyone keeps nodding along, that's not prosperity. That's kindling.